So what we see here is a clear advantage by owning this investment over SCHD. If you're an average Joe investor out there, if you want to actually retire with enough income, then you can't choose SCHD. What's up, you guys? Welcome back to the Average Joe Investor channel, where we talk exclusively about all the different ways that you can create income in your own portfolio. Now, there's no doubt about it. SCHD, the Schwab Dividend Equity ETF, is by far the most well-known and, you might even argue, most effective dividend ETF out there. And it's full of high-quality dividend stocks that do a great job of raising their value year over year and paying increasing dividends. Now, I'm not disputing the fact that SCHD is probably a pretty good fit for a few people. But here's the hill I am going to die on. For the average Joe investor out there who thinks that they're going to just continuously buy more shares of SCHD over time and hope to eventually reach the top of the mountain and be able to live off of their SCHD dividends, you specifically should probably sell all of your shares of SCHD. So SCHD has been in business now for a little over 10 years. And they have a great track record. They've got a really low expense ratio. They own high quality dividend stocks that have a history of raising their dividend every single year for many years now. And they currently have a distribution yield of 3.34%. Perhaps the best part about SCHD is their dividend growth rate history. They have a long and storied solid record here. Like, as you can see, 10-year growth rate, 11% of average growth year over year of the dividend. And they've been growing their dividend now every single year for 12 years, which is the entirety of the history of SCHD. Even though the 3-year compound annual growth rate is a little bit lower, it's still very good. So SCHD has a really solid and respectable dividend yield currently. Their dividend growth rate is amazing, best in class when it comes to dividend ETFs, and they own high quality companies. What's the problem? Of course, I built a spreadsheet here. What we're looking at is what would happen with SCHD based on a few different assumptions. First off, assuming that we started to buy into SCHD starting with $0 when the fund launched in 2011 at a rate of $250 a month. Then we'll also look at what if we dropped a lump sum of money into SCHD, $100,000, and what would that grow to? And then third, what kind of scenario might you actually choose to retire in SCHD? How much money would that take? What we're comparing SCHD to today is the S&P 500. SPY. We're going to do a apples to apples comparison with both of them. And if we're going to do that, then we have to look at not only the amount of income over time, amount of shares over time, but also what that portfolio grows to. And here's the first main point I want to talk about. Why would you invest in SCHD when you can do better with the S&P 500? As you can see here, over that time frame, if you take SCHD, start with $0 here, we start contributing $250 a month. We scroll all the way down here. By the end of, currently 2024, October 10th, you'd have 839 shares if you were not reinvesting dividends, but of course we would be. So of course we'd have a total then of 1,087 shares. And those shares in total would be worth $92,165.14. Now we compare and contrast that with the S&P 500, where we start with $0 again, the same $250 a month, starting October 20th, 2011. And if we were to take that, scroll all the way down here, if we were not reinvesting dividends, we'd have 158 shares, 158.275. But of course, we'd be reinvesting dividends along the way. That'd be 182.267 shares. Those shares in total would be worth $105,213.61. If we invest in the S&P 500 instead of SCHD, we have more money. Now, of course, you might be saying to yourself, well, okay, that's fine. I have more money with the S&P 500, but my SCHD shares are going to keep growing, and I'm going to get more shares, and those shares are going to pay me more income than the S&P 500. And you would be correct from that perspective. Now notice here that the total dividends pay here, $7,700.68 in total during that time frame when you're reinvesting shares, reinvesting dividends for the S&P 500, $7,700. With SCHD, we'd be at $15,143.38. So yes, you certainly would be getting more income. But this number right here, 15, is not an annual number. That's in total since 2011, you received $15,000 in dividends. So the question then becomes, how long would it take you to continue investing into SCHD to get to a point where you can actually live on the dividends? Well, it's hard to know because I think most average Joes out there are not capable of investing $500+ every single month. And maybe when you're in your 40s or 50s, you have that capability, but we're talking about the average Joe investor out there. That's not a real viable option. So let's look at a second scenario. Let's assume that instead of investing on a monthly basis, let's assume we start with $100,000. We're not going to make any monthly contributions. We will reinvest all distributions along the way, all the dividends, and see where we end up in the same time frame. So SCHD, start with $100,000, scroll all the way down here. We have $508,232.74. With the S&P 500, scroll all the way down, same idea, start with 100, $602,772.05. So whether you start with a lump sum of money and let that grow over time, or you invest and start from zero, invest along the way, $250 a month, the S&P 500 continuously outperforms SCHD. So again, I ask you, why are we choosing SCHD? There's not enough income there. As you can see here, if we started with that $100,000, we'd have total dividends during that time frame of $61,594. And it looks like our dividends would be right around $1,800, so only about $7,000 or $8,000, maybe, give or take, annually for the S&P 500. With SCHD, we would have total distributions of $109,000, and our total income would be around $4,500, and that would be quarterly here. So maybe is that $18,000? So you've got $500,000. And it's only creating for you $18,000. For most people out there, that's not going to be enough money. So for the average Joe investor, it doesn't make a lot of sense. But maybe, let's say you either come into money or you did really well with your investing and you now have $1 million. $1 million. Does it make more sense to buy $1 million worth of SCHD and live on the dividends? Can we live on that? And then also, would we be better off with just having $1 million in the S&P 500? Okay, we have two new tabs here. SCHD, $1 million retirement, and then the S&P 500, $1 million retirement. What we're looking at here is a $1 million lump sum investment at the beginning of the period, October 2011. You decide you're all in on high quality dividend stocks and you want to live on the income. So let's look at what happens here. Okay, we're not making any contributions. We're not reinvesting any dividends here because we're living on the income. All the way at the top here for SCHD, we start with $1 million. We're going to look at the lump sum value here over time. We're going to scroll all the way down here. At the end of the period, that same $1 million that we're not reinvesting any dividends has grown from $1 million to $3.39 million right here. And you'll notice here that now we're receiving quarterly distributions in and around $30,000. Total distributions during that time would be $861,000, okay? $30,000 here. And then, so it's probably around $120,000 in annual income. Okay, now this is in year 12. We retired in year 1. Okay, so we'll have to look at how much income we got in year 1 along the way as well. S&P 500 here, let's look over here. We start with $1 million, not reinvesting any distributions. Scroll all the way down here. Our $1 million is now worth $4.74 million. So 4.74 versus 3.39. So with the S&P 500, we have $1.2 million more than what we had with SCHD. Now you might be thinking, okay, that's great. You know, of course the S&P 500 outperforms SCHD, but let's look at the income, right? That's fair. With the S&P 500 here, the most recent distribution here, quarterly, is $14,000. So that's about, $56,000 annualized. And in total, we received $532,000 in distributions during those 12 years. But let's look at a year-by-year breakdown of that income compared to the portfolio balance. Okay, so here we've got the S&P 500 versus SCHD. This is the lump sum value starting from $100,000. And what we can see here is the S&P 500 outperforming, like we talked about, and pretty much outperforming the entire time. This is not reinvesting distributions or dividends. And then we've got here dividends reinvested, same figures here, right? And there were times when the S&P 500 was fully matching and even actually outperforming a little bit, maybe right in this area, right around 2022. But overall, the S&P 500 wins here on reinvesting distributions when you start with $100,000. Here's where I think the meat and potatoes is. We're looking at 4 different lines here, right? We've got it's on 2 separate axes. On the left side here, we have annual income. On the right side, we have portfolio balance. The annual income is tied to the bar graph right here. Green is SCHD income. Red is S&P 500 income. And then the red line is the S&P 500 portfolio balance tied to this axis over here. The black line is SCHD. And what we can see, based on these snapshots in time along the way, is that the S&P 500 outperforms on portfolio balance, which we knew. What we see is the income is actually relatively close in year 1, $32,000 versus $25,000. But year over year, we see that the dividend income with SCHD is slowly outperforming and gaining more and more steam because, of course, that dividend growth rate is higher for SCHD than it is for the S&P 500, which makes sense because that is one of their key objectives, is to not only have quality companies that pay good dividends, but that those dividends are increasing consistently every single year. And we see that here by year 12, year 13, we're at over $100,000 in distributions or dividends versus only $50,000 right here. Okay, so if you have $1 million, right, and you've got a choice between the S&P 500 and SCHD, and we're looking at the ability here by year 10, 11, 12, of course, if you've been able to live off of 30 or 40,000 for a few years before the dividend had grown even more, it certainly seems like a lot of sense to stick with the SCHD distributions because they're growing every year and you're earning now over 6 figures in dividend income. But what about the S&P 500? Is this the complete story? Yes, we're getting distribution income here that is far superior with SCHD. But remember, you also have $1.2 million more, so you could be drawing some of that money out to match it. But here's the key piece of the conversation that most people don't take advantage of that you absolutely can. That is the key game changer here with the S&P 500 versus SCHD. We're talking about selling options, specifically covered calls with the S&P 500. Now, you could technically sell covered calls with SCHD, but the amount of volume liquidity is not really great at all, and there's not a lot of premium to be had. But with the S&P 500, you have the most liquid options market in the entire world. And with the S&P 500 here, if we look at this options data here, I took a snapshot of the option chain, which is current right now. Okay, and what I wanted to look at was, what if we took all of our shares or even just a portion of our shares and we started selling covered calls? Now, when we sell covered calls, we are going to be capping some of our growth. So it's very possible that if we'd started this in year 1, it could result in a lower portfolio balance, but I don't care. And you shouldn't either. Now, full awareness here, this option chain is based off of the price 575, but the price in 2011 was much lower at 121 versus 577, which means that the option premiums are going to be lower as well. So I had to factor that in here. So the factor I worked with is not perfect, but I assume that the difference here of 577 versus 121 is a factor of 4.76 times higher. So what I did is I reduced all of these option premiums by a factor of 4.76. So what we're looking at here is a one-day option selling strategy along with a weekly option strategy, both at the money, these two options here, as well as further out at a 20 delta and a, what we call this, I guess, a 35 delta here. Now, what this means is, with the at the money means we're super aggressive and we're not collecting any capital appreciation. Okay, but with the 20 or 35 delta, we are getting some income, less than with the at the money, but we're also getting to participate in some of that capital appreciation and still getting really good income. So what would it look like here? Assuming that we had $1 million back in 2011 with the S&P 500, and assuming a price of 121 at that time, that means we'd have the ability potentially to have, what, 80 contracts here? 82 contracts? Because remember, every contract for selling options is worth 100 shares. So we'd have the ability to do 80 contracts here, but I went super conservative. What if we only worked with 40 contracts, or half of our portfolio was for creating income from selling options, the other half was not? And then over here, only a quarter of the portfolio, 20 contracts versus 40 contracts. Well, if we took these numbers here, reduce them by that factor, the 4.76 factor, if we were to sell at the money every single day, we'd be collecting somewhere in the range of, plus or minus, $1,700 per day with only half of our portfolio, which would equate to $36,000 per month, or about $434,000 per year. That $100,000 from SCHD in year 10 looks pitiful compared to this. This is year 1. Year 1 income. If we only used 20 contracts, so only a quarter of the portfolio for income at the money on a daily strategy, we'd collect $861 per day, $18,000 per month, or $217,000 annually. And this is also going to fluctuate because we know option premiums are going to fluctuate throughout the day and throughout the year. Now, if we went a little bit further out, right, instead of doing an at the money daily strategy, which is by far the most aggressive strategy, what if we went out of the money at a 18 or 19 delta here? Then we'd collect about $378 a day if we were doing half of our portfolio of 40 contracts, $7,900 per month, or $95,000 per year. Again, this is year 1, not year 12 when SCHD is doing that. SCHD is making about $32,000. If instead we only use 20 contracts at this 20 delta, we'd collect about $189 per day, $3,970 per month, or about $47,000 per year. Now let's assume instead of going daily, we wanted to go weekly, right? Because maybe some people just don't want to log in and look at their portfolio on a daily basis. Totally appreciate that. Here we'd collect on a weekly basis if we were doing half of our portfolio. And this is weekly, a weekly option strategy, but doing it at the money. We clicked about $3,600 per week, $15,000 per month, and about $189,000 per year. If we only used a quarter of our portfolio, it'd be $1,800 per week, $7,800 per month, and then $94,000 per year. Now, let's assume we went out of the money here to a 35 delta, right? And we used half of our portfolio, it'd be $1,900 per week, $8,400 per month, and then $101,000 per year, versus only a quarter of our portfolio, $974 per week, $4,000 per month, and then $50,000 per year. What this means here is that the other half or 3/4 of our portfolio is growing with the market and not being limited whatsoever by selling covered calls. And this, by the way, these numbers here does not include the extra dividend income you'd receive by still owning the S&P 500. So what you see here with the S&P 500, if you choose to sell options, is income far, far superior than SCHD. Even if you're starting with $1 million here, the amount of income you could generate is far superior with the S&P 500 compared to SCHD. All of this is great, and maybe some of you are now thinking, man, I really should be thinking about options, but I haven't even told you the best part here. Remember, this channel is all about the average Joe investor, being able to help the average Joe live on their portfolio in retirement, potentially even in perpetuity. So let's dive into the really special part of this strategy. Make sure to check out next week's video. It's going to be a continuation of what we're already talking about, the real special part about selling options with the S&P 500 compared to owning dividend stocks or a dividend ETF.